All right, let's dive right in. We're going to unpack a huge economic standoff that's happening right now at the Federal Reserve. It's this giant puzzle with all these conflicting signals, and honestly, it has some massive consequences for your wallet and the entire market. So let's get into it. This one question really just gets right to the heart of everything. Is the Fed about to suddenly pivot on its policy? Or are they setting a calculated trap, basically forcing traders to second guess every single move they make? It's the multi-trillion-dollar question that everyone on Wall Street is dying to answer. So first up, let's try to decode what the Fed is signaling and figure out if this really is some kind of calculated trap. What's causing all this drama anyway? Well, it all boils down to the latest economic data, which is, to put it mildly, painting a very conflicted picture. It gives the policymakers really strong reasons to both cut interest rates and to hold them steady. This isn't just background noise, you guys. It's a huge strategic challenge for the Fed. Let's just call this what it is, an economic standoff. You've got two powerful opposing forces pulling in completely different directions. On one side, you have key data points just screaming for the Fed to ease up on policy. But on the other side, you've got numbers that suggest the economy is still running way too hot. And the Fed, they're caught smack dab in the middle. Okay, so here's the conflict in a nutshell. On one hand, you've got cooling inflation, which is exactly what the Fed has been working towards. This is the main argument for cutting interest rates, to give the economy a little boost. But then, on the other hand, you've got this stubbornly strong labor market. A hot job market means more people are earning and spending, and that can keep inflation from falling any further. So that data argues for keeping rates high. Two key indicators telling two totally different stories. And listen, this isn't just some abstract problem for economists to debate in a classroom. This conflict is sparking a very, very real debate inside the Federal Open Market Committee. That's the group of people who actually vote on these interest rate decisions. You can bet they are looking at the exact same confusing data we are, just trying to make sense of it all. So how in the world does the Fed handle a standoff like this? Well, they can use a strategy called a data-dependent pause. What does that mean? Put simply, it means their next move is to, make no move at all. They hold rates steady, they don't promise anything, and they just wait for more data to hopefully paint a clearer picture. It's a strategy of active patience, right? But for the markets, it can feel like pure, agonizing uncertainty. Okay, so what about Wall Street's reaction? The Fed's indecision doesn't just happen in a bubble. Oh no, it sends these massive ripple effects all across the market, and it affects investors, traders, and major parts of the economy. First up, the impact on tech stocks. High-growth tech companies, as you probably know, are super sensitive to interest rates. Why? Because higher rates make their big future profits seem less valuable today. So this whole will they or won't they game from the Fed can cause these wild swings in the Nasdaq as investors just scramble to price in whatever might happen next. Second potential impact, a stronger US dollar. Think about it. If the Fed hints that rates might stay higher for longer, it makes holding dollars way more attractive for international investors who are looking for a better return on their money. This could easily push the US dollar index, the DXY, higher, and that has its own huge consequences for things like global trade and company profits. And third, we could see a major shift in where the money is going. In times like these, when things are uncertain, traders often pull money out of the riskier growth stocks like tech, and they rotate that money into more stable defensive sectors. We're talking about things like consumer staples or utilities, the companies that provide stuff people need no matter what the economy's doing. So the chain reaction is pretty clear, right? Fed uncertainty can lead straight to tech stock volatility, a stronger dollar, and a flight to safety in those defensive stocks. These are the three big market signals that traders are watching like hawks right now. So, after we've looked at the data, the strategy, and the market reaction, the big question really comes back to us. Because this isn't just a puzzle for a bunch of Wall Street pros. This is a situation that directly affects anyone with a savings account, a 401k, or a mortgage. It's your call too. So I'll leave you with this final thought. Do you think the Fed is playing it safe, being cautious, and making absolutely sure inflation is dead and buried before they cut rates? Or are they waiting too long, risking a pretty serious economic downturn by keeping policy this tight for this long? There's no easy answer here. What do you think is the right call?